Greetings, this is Manu Walia from Continuing Global Asset Management. Today is May 12th, 2021, and the reason of this small video slash presentation is because we just recently put our April 2021 newsletter, which was primarily bearish, and we've been asking clients and potential investors to be a little cautious in this market and raise a little bit of cash. And the change of events happen so quickly that there is a big divergence between valuations and perception slash reality. So what we wanted to do is wanted to go through the newsletter, why we came to the inference that we should raise a little bit of cash and be cautious right now, and then the turn of events over the last week or so where the NASDAQ has lost almost 8 or 9% and the volatility index has spiked up from 16 to 26, which is a 60% gain. In other words, people are worried today that we might be looking at inflation, things may be turning, and we may be looking at another correction. So here goes. The first thing we wanted to talk about is what's happened in the markets over the last decade or so since we had the 2008-2009 financial debacle. If you look at the markets over the last 2 decades, we will see that we have gained approximately 100% per decade, which really is normal because if you averaged out the movement of the Dow Jones Industrial Average over the last 100 years, you will see that more or less the market doubles every decade. There is a caveat there. It only doubles on an average every year if the US GDP is growing at about 3%, which on an average it has. There are time frames where it hasn't, or there are time frames when the markets have not grown at 100% or doubled every decade. The purpose of this particular slide was to just show that even though the markets have gained 100% every decade for the last 2 decades, and we've had 2 major corrections, one in 2000 through 2003, and the other one in 2008 and 2009. So my point here is that despite a bullish phase of 2 decades, we will and we have seen tremendous slash significant corrections while we're moving up. So it makes us think about how important valuations are, despite the fact that we could be in a very strong and robust economic expansion or recovery. Next slide that I'd like investors to look at is to look at the fundamentals of the economy, which are comprised of so many different variables. I just happen to take about 20 variables, and I'm looking at how these variables are doing relative to the last 3 months and relative to the last year. Without going into the detail, if you took the aggregate of variables like consumer sentiment, home sales, retail sales, manufacturing, building permits, and the list goes on, you can see that there are more green signs, or that the US economy is actually rebounding after a decline that we saw last year due to COVID. Now, this may not be a very clear illustration of what I'm trying to say, but if you look at the next slide, this is an aggregate of those 20 variables, and this is an illustration of the average of these variables, how they're improving relative to the last quarter on each quarter basis, on quarterly basis. So if you looked at the mean of these variables, you will clearly see that we are currently in an expansionary phase. So what does that really tell us? What that tells us is that there is a divergence of the economic variables and the valuation. We believe that the markets have actually gone to such a euphoric stage that most investors are looking at things that they will continue to get better. There's more money from the stimulus package that's coming into the economy, and this trend will continue. We don't agree with that. We believe that valuations have gone to a point where we will see a correction. And case in point, currently we're in the second, maybe the third week of May, and the NASDAQ market has actually corrected by about 8 or 9%. The Dow Jones and the S&P are down about 4 to 5%. So the euphoric area of the market is deflating. Just a thought comes to my mind. There's a lady who's very, very smart. Her name's Kathy Woods. She manages, I don't know, 80 to 90 billion dollars, and the name of the company is ARK Investments. If you look at some of the ETFs, the funds that this company manages, they've lost about 30 to 35% in the last 2 to 3 weeks. So all I'm trying to focus and emphasize on is, just because we believe that the fundamentals are great and the economy is rebounding, it doesn't mean that we can ignore the valuations. Hence, we published our April newsletter, which was very cautious, and it was a follow-up on our January newsletter, which was also cautious, and we wanted clients to raise cash. Now we're going into a phase where we are seeing this retrenchment / correction in the market, and one of the variables that we look very closely is the volatility index. The volatility index has spiked up from about 16.5 just a couple of weeks ago to about 26.5. That's a 60% increase. Every time the VIX index goes above 25, in other words, the markets are worried, we take a contrarian stance and we start to invest. So even though our newsletter is saying that we should raise cash, I think within the last couple of weeks, we are seeing a lot of areas that we can invest. So we would be actually nibbling on some of the companies and sectors that we believe will do well in the long term. This is an opportunity. So despite the fact that our April newsletter says raise cash, I think we are coming close to the point where that cash should now be invested in the market. Again, thanks for listening. And if you have any questions, please give us a call. You can find the numbers or contact information on www.cgamadvisor.com. Thanks again and good luck investing.